Welcome to TheoTrade. This is Don Kaufman, April 27th, 2020. We've got about 20 minutes left inside of today's cash session with the S&Ps, once again, ripping to the upside. But it is not the S&Ps that I'm looking at right now. It happens to be none other than, well, the little engine that could. The Russell is flying by the tune of about 5%. Now, in a few minutes, we're going to look at a little bit of volatility. We're going to look at the overall market and what it's doing. But I think what's of critical importance right now is, correlation and, more importantly, even divergence inside of this marketplace. This is not something that you might look at typically on a day-to-day basis, but I want to show you a little bit about, again, what we call correlation and, more importantly, again, what we term divergence in this marketplace and precisely how I am actually trading this marketplace right now. So for those of you that do tune in kind of on a day-to-day, week-to-week basis, you'll hear that I am once again kind of re-upping a few short positions. And in doing so, you're looking at this. When I say I'm re-upping short position, I really want to clarify and kind of quantify exactly what I'm doing in here. I'm actually creating positions, okay, that have what we term negative delta, which is, okay, absolutely unequivocally bearish. Okay, so you're creating bearish positions. Well, where are you doing bearish positions? Well, that's exactly what's critical to understand here, and it has everything to do with the fact that divergence inside this marketplace is huge. What I want to show you is I am absolutely, again, creating negative delta, and the S&Ps today are up big. Okay, so typically in negative delta, when the S&Ps are up big, you should be what? You should be losing money. You should be losing money on a day where, again, negative delta. What does negative delta implies? Okay, that again, I am outright short that marketplace. Okay, I am shorting stock in some way, shape, or form. But once again, let's actually come over for a second to P&L on the day. And again, I'll even show you some of the short positions that I've created in here, but more importantly, kind of P&L on the day. And I don't mind showing this in any way, shape, or form. Listen, okay, as it stands right now, in terms of margin requirements and so forth, you can see I'm about $76,000 deep. Okay, I've created all kinds of, negative delta, not too crazy, right? I'm actually SPY beta weighted right now, and I'm negative in this particular kind of sub account right here, negative about 550 spider deltas, add a little more negative delta over here, offset by a little positive delta down here. Net, what am I on the day? Massively unchanged. So I wanted you to see that we're having a day where I am absolutely, again, negative delta. We are rallying, and the S&Ps are up almost 50. Okay, but we're almost flat on a trading session. And I have to tell you, most people wouldn't show their P&L when they're down in the day. Listen, now I'm down $118. Okay, that is an absolutely huge win. And that's one of the things that most people, they look at their accounts, and I'm showing you kind of the full Monty over here. I'm not isolating to one account. I'm showing you right now two accounts that have over, $730,000 in both accounts. And yeah, I'm only using about $76,000 of margin. Granted, part of this is portfolio margin. I'll put that in there. But a day where the S&Ps are up some 50 points, you're only down a negligible amount, I think is of critical importance. And again, how is that even possible? Okay, and that's exactly what I'm going to show you. So I've been very, very sector specific, and I've talked about this lately being like, this quant marketplace. And for those of you that know this, okay, where have I wanted to be short? Technology, okay, tech, because I'm expecting the next rotation in this marketplace to effectively come out of tech. At the exact same time, though, that I'm short in technology, and I'll be really specific, I'm actually got some short positions inside of Microsoft. I actually stepped into a short position inside of Facebook. I've actually got a short inside of Intel, and I can go on and on over here. But on the flip side, I'm actually long right now inside of the energy sector. And there's a few other short positions I've got on right now. I believe consumer staples is going to get hit. So I've actually got a short position in Costco, short position in Walmart. Okay. But then on top of it, I've actually offset some of those short positions, okay, by a back ratio inside of the IWM. Okay. Knowing that the IWM is down big on a percentage basis in a year to date. In fact, I'm going to show you that right now. Take a look at the IWM. It's down some 22% a year to date basis. Whereas if you look at the QQQ is massively unchanged on the year. So we expect, again, if this is a quantitative marketplace, which we believe it to be now, there's no fundamentals because the Fed has come in there and destroyed our bond market. It's okay to say that now. Then effectively we should see, again, sector rotations. out of the Nasdaq, or specifically out of individual tech stocks and into, for instance, the Russell, you should see a big bid coming in under financials. Now, I'll tell you what, I am not in any long financial positions, but that's just a choice on my behalf. I have a tough time being long financials in the midst of a crisis over here. So everybody right now is looking at this marketplace and like, it just keeps going up. Okay, I get it. And at the same time it keeps going up, I'm actually stepping in and starting to short stuff. Okay, I'm not taking a loss on an intraday or daily basis, and I'm just, chugging right along. We're fine. How was it done? Well, one of the things that's really striking over here inside of the marketplace is correlation. Let me start with correlation to clarify how this is going on. If you take a look, and I'm going to close up this left side bar. If you take a look at the S&P 100, okay, S&P 100. When I say correlation, okay, what I'm talking about right now is, for the most part, when the S&P futures move, right? That's the S&P, all right, 500 futures contract. Now, most people don't necessarily look at the S&P 500 futures contract. That's okay. But when the S&P 500 futures contract moves, so goes the entire basket. Everything is tied together and perfectly together right now via what's termed statistical arbitrage. It's, again, if the S&Ps move up and down, it's going to move the entire basket up and down. So for the most part, looking at individual stocks doesn't necessarily do it for us. It becomes more of about sector rotation, again, when we have high degrees of correlation. And I'll show you a little bit about sector rotation here in a moment. But the bottom line is, if the S&Ps are moving higher or lower, the entire basket is going to move higher or lower. Now, you have to be very, very cautious in a marketplace like this. And at this point, I actually want to pull up the spiders, because anything you do inside of the marketplace, and this is something I was talking about on the weekend update, and I really mean this, anything you do in this marketplace, it doesn't matter whether you're bullish or you're bearish. If the market breaks to the upside, okay, if you're bearish, you're going to get toasted. If the market breaks to the downside, all right, and you're bullish, you're going to get toasted. There's just no way in between this. So what you have to do in a marketplace like this is you have to start to align yourself long, short, all right, long one sector, short another sector. Again, I'm overall short, but I'm only short about, 600 SPY deltas net, which is a negligible position for the kind of size that I'm working right now. But the point that I want to make with all of this comes down to, well, this, okay? I'll have tendency to look on a day-to-day, a week-to-week basis at, for instance, pairs trades. Now, I've actually held back from really showing charts like this because I'm going to try to water this down a little bit. Some of this is going to get a little bit complicated for a moment, so bear with me. What we're looking at right now is the QQQ, okay? The QQQ. All right, versus the IWM. And there is just an absolute massive divergence between the two of them. As I was showing a moment ago, the QQQ on a year-to-date basis is basically 0%. The IWM on a year-to-date basis is effectively down, okay, 22%. Huge gap between the two of them. Now, it's not fair just to look at something on a year-to-date basis, but it's a year-to-date basis that really kind of grabbed my attention initially. So with that, it really kind of struck me, and it said like, hey, you know what? Bring up the pair. So when I bring up the pair, what you're looking at over here is literally the Qs minus the IWM. And these trade relatively flat, and all of a sudden they just trade in some wild divergence. Now, what that means to some people, well, sometimes a little hamster gets stuck in the wheel. This is kind of a weird idea, but the QQQ over the last couple of years, and this is the QQQ, all right, and then we have the IWM, and if you put them on a comparison chart, the two have actually diverged, and diverged quite massively from one another. And even more recently, right here, that has accelerated. And again, the Qs are 0% year-to-date basis. This is down 22%. Well, guess what? There's a trade in here. There's a huge trade in here, and it doesn't have to necessarily be pairs trade. Okay, for the most part, at this point, I'm looking at it like a sector rotation. I'm going to make it easy. I don't want you necessarily to pair up. Okay, all we're doing is shorting a couple of major tech stocks. Okay, and going outright long in the Russell. Where am I going long in the Russell? I'm going long some IWM. I'm going long a couple of RTY futures. Okay, I've actually built a ratio back spread, which I talked about in the weekend video, the ratio back spread inside of the IWM. It's a party. Anyway, I'm getting long in there. What you're looking at over here, though, I'm actually going to show you in mathematical terms. I'm not the guy that likes to look at charts a lot. I'm not the guy that's going to spend time and look at the MACD, look at the Fibonacci. It's just not going to do it for me because, in a sense, you're going to miss the opportunity by spending time, looking at this. Now, visually speaking, yeah, this is striking, but what it really comes down to for me is going to be standard deviation. What standard deviation is, I'm going to pull up, well, here it is. I'll just explain it as we actually pull it up. Okay, so anytime we're doing a comparison or any type of pairs trade on here, we actually use line charts, not bar charts. Okay, this is actually the pair correlation. This is how one product, reacts basically to the other. And if you take a quick glance right over there, it's, you're sitting just shy of about a 90% correlation, which means that the products are kind of moving, if you will, in relative tandem. So when something has a heavy, again, correlation, it's moving in relative tandem. When they break apart, it's said to be divergent. Some huge divergences occurred earlier in the year. But even more important, okay, is to break this down in terms of a pair's standard deviation. Okay, and the pair standard deviation speaks volumes. So right here, this is basically, okay, the zero barrier. This would be 1 sigma, up here is 2 sigma. So right now, if you looked at this on a distribution curve, what you are seeing, okay, in terms of the divergence, and what we're looking at down here is this pair standard deviation. The pair standard deviation is doing nothing more than mathematically interpreting, okay, this huge move. Okay, so we were kind of flat in terms of what? The QQQ versus the IWM, and then they just diverged. But putting that divergence into terminology, okay, all of a sudden your 2 sigmas out. But that's on just a 9-month basis. So let's get rid of all this, scratch all this, kind of come in here, and we'll hit what's called auto arrange, kind of snap things back. Again, that's just a 9-month basis. It's not fair to ever look at any type of pair, okay, or any type of correlation on that short of a time frame or in one time frame. So I pulled this up for 3 years. Okay, on 3 years, look how striking that is. Wait, it gets better. So let's not just pull up 3 years. Let's actually pull up, okay, from the beginning of time. No, in this case, we're actually going to pull up 15 years on a monthly. And I wanted to show you, it doesn't matter what time frame that I use in this particular circumstance, the divergence that's now gone on, okay, between the QQQ and the IWM, it isn't just striking. It's the biggest divergence ever that has been recorded between these two. And you can even look back. I love to compare to 2008. Oh, look, the divergence got out there in 2008. Okay, but right now, how far out are we? Okay, so this is kind of the zero barrier. This is 1 deviation, 2 deviations. Okay, then you could probably look at 3 deviations. I mean, you're somewhere near like a 4 sigma move in terms of how far out of whack the IWM is versus the QQQ. So what do we anticipate to have happen? Okay, well, this is where we actually can come right back and we can start to look for trading opportunities, and we expect in some way, shape, or form that the QQQ and the IWM are going to converge. And that really sets up my trading. And you can see all kinds. There are pairs trades in here. There's IWM versus QQQ, a couple of futures contracts and some micro contracts and a partridge in a pear tree, another IWM position down below. But net, when you have an account, okay, you have an account and you're actually running about $76,000, but it's a portfolio margin account and you're down a whopping $200 in a day where the S&Ps are up some 44, you are doing something right. Okay, and I like to show positions like this because I want you guys to know, yeah, I'm shorting the marketplace right now, but it doesn't necessarily mean I'm taking a hit when the S&Ps are up 45, and I know some of this is confusing. Last but not least, what I also wanted to detail today, and again, I'm just throwing that out there for those of you that are on TheoTrade on a day-to-day basis, I promise, okay, while we're live in the chat room tomorrow, okay, Wednesday, I will absolutely explain the mess that, of course, I just made, but it's important to know where some of the ideas that I'm getting are coming from, and that's a big one, the IWM versus QQQ, and I've got a lot more. But a few last things I want to point out. One thing is they're buying a little bit of volatility today. This is kind of the Maginot line over here, the 110 region north of the VVIX, the VVIX. We are a slight buyer of volatility today. That one's a bit striking because we haven't bought any volatility lately. But again, the VVIX is still at the 120 range, which is just raging volatility. But there's one other interesting aspect that's going on right now inside of volatility, and that has to do with the volatility futures themselves. Okay, Because today we've actually gotten very, very close to dropping back to more normalized volatility. We ain't home just yet. Don't look at these. This is a weekly. They don't trade. Okay. All I want you to look at is right here, right here, right here. And we have just a very, very mild inversion right now. Okay. Last week, that thing still looked like this. Okay. Normal volatility looks like this. And effectively what it means is the risk is still here. The risk is still now. The risk is still, the preeminent factor in this marketplace. But some of that risk has really come off a lot lately. And don't just look at the level of the VIX, because that's going to be worthless. Look at the structure, okay, of volatility right now. We're still in the short duration. We have 34 vol. In the back month over here, we have a 32 vol. It's still a party, people out there. And as long as those volatility futures are inverted, expect anything can and will happen inside of this marketplace. Clearly, I've kind of given you my thoughts over here. Yeah, I'm short the marketplace, but it's target practice. Okay, I know that the biggest of the big are coming out with earnings this week. I get it. And I'm still willing to actually withstand the risk, because right now, okay, it ain't about fundamentals. It's not even about earnings. It's about correlation, and it's about divergence. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.